Welcome, everyone. My name is Neal Bawa. I'm your host, turning it over to my co-host, Scott Maurer. Scott?
Hey, Neal, how are you doing?
Terrific, terrific. Good day to do a webinar, I think.
Yes, it is. I can just share my screen here, I guess, and I'll pop into my brief portion of the webinar, and hopefully everybody here is get some good information, obviously, from what I say here for a few minutes, and obviously what Neal's going to share with us on real estate trends. But I wanted to talk just for a few minutes on kind of the basics of finding and funding a real estate deal with a self-directed IRA. I'm sure many people on the call are aware of this and how this may be done, but there's certainly some people who are either unfamiliar or need a quick refresher. Just a quick bio on myself. I'm the Director of Business Development for Advanta IRA, also a licensed attorney. I don't do any legal work for Advanta clients, but I do have that background from an educational perspective to speak to a lot of the issues that we talk about when we get involved with self-directed IRAs and real estate. A quick disclaimer, kind of one thing that we don't do at Advanta IRA is we do not provide any legal tax or investment advice, and we don't endorse any particular products or any particular companies. We exist to provide a service for assisting people with a self-directed IRA and using an IRA account to invest in real estate. But anyone who uses our service is encouraged to do all of their own due diligence on an investment and the people that they're working with. A little bit about our company. We've been in the industry over 15 years. We have over $1 billion in assets. We really pride ourselves on the fact that we have an account manager kind of customer service system where every new client gets placed with the same account manager or an account manager who then works with them regarding anything regarding their IRA account. So whether it's a new investment or questions on your account, you have one point of contact. You have that person's name, phone number, and email address. You're not sending it to just a general email box or calling a 1-800 number to get answers to your questions. I think that's really the strength of what we do here. We're also big proponents of education, so that's why we're happy to be on the webinar here with Neal today. Just very quickly, again, wanted to run a little bit over self-directed IRAs for people who may not be interested or maybe not be knowledgeable about self-directed IRAs on the call. Very quickly, what is a self-directed IRA? It's the ability to use funds in your IRA, in your old 401k fund, and invest in alternative assets. And I'll go over kind of a list of different real estate assets we have that our clients invest in just a moment. But the common thread with all the investments that are held in a self-directed IRA is simply that banks and brokerage firms typically only offer you those things that they want you to invest in or that they sell. It doesn't necessarily mean that that's your only option. So a self-directed IRA is one in which you decide what type of an investment you want to make, because IRS regulations do allow for a very broad range of investments. Probably 75% at least of the investments that we hold at Advanta for our self-directed clients are in the real estate realm. And we'll again go over what some of those assets are in just a minute. That's why we are always doing our educational events and partnering up with people who speak to a lot of real estate issues, because that makes up such a large part of our clients' portfolios. People choose to self-direct to get their funds out of the market for a couple of different reasons. For some, it's just a new source of capital. This is very common with the real estate investment community. People who are buying and selling single-family homes, or they're investing into multifamily syndications, they may already be doing that on a personal basis. They've already bought a couple rental properties. They've already invested in a couple of other commercial and multifamily deals. Their IRA is just another place, another source of capital for them to use towards that investment. A number of other people, though, are fatigued. They're tired of the stock market. That it goes up and down. There's a lot of geopolitical events that can influence the stock market, which in turn influences your bottom line on your IRA and on your 401k return. And that makes a lot of people unsettled. They can choose an asset. They can find a piece of real estate to invest in instead. Makes them sleep a lot better at night. And for a number of others, there's also the tax benefits. When you invest in an IRA, Roth IRA, old 401k, you generally do so on a tax-free or tax-deferred basis. So the income that you generate from your investments inside your IRA and 401k does not impact your personal tax return when you're making those investments. That's one of the reasons why a lot of people do choose to self-direct. And on a kind of another note, you have people who are looking to raise money from self-directed IRAs. They're looking to find other investors to work with. Why are self-directed IRAs a good source of capital? I think for several reasons. One, it allows you to go to your existing investors, people you're already working with, and say, hey, here's another way you can invest with me. So it's a repeat investor. You don't have to sell anyone on investing with you because they're already invested in some of your projects. It's simply showing them another way to use their IRA and hopefully open up more capital for yourself. With IRA accounts and 401ks, a lot of people are not expecting to touch that money anytime soon anyway. So if you're investing into you're looking for an investment into a project that might take 5-10 years out, it has good returns, individuals will place their money in that investment with an IRA maybe more readily than they would do a personal savings or a rainy day fund, that they don't want that money locked up because they may need it. But most people aren't expecting to touch their IRA anyhow. Certainly you can get better returns. I think you could offer better returns to people than what they're getting in a CD, or again, if they're afraid of the stock market. And there's no outside approval needed. Somebody who has money in an IRA or 401k, once they decide that they want to make that investment with you, there is no advisor or broker that's going to put the stop on that deal or try to counsel them out of it. It's completely their decision to make in making that particular investment. Now, as far as the kind of accounts that you can self-direct, any type of IRA, whether it's a traditional or Roth IRA, if you're a small business and you have a SEP IRA, a simple IRA, or an individual 401k plan, that can be self-directed. And certainly any former 401k, 403b plan. When you have an old employer's plan, somewhere you don't work anymore, you can always move that money into an IRA. The only restriction is on current 401ks. If you're involved in a current 401k with your employer, they may place certain restrictions here and there to limit how much money you can move or if you can move it at all. But no restriction on IRAs and old 401ks. Moving the money, again, this is something that sometimes your financial advisor gets confused about. When you tell them, I want to buy real estate with my IRA, or I want to invest in a project with my IRA account, they think you're taking money out as a distribution, which would be taxable to you. So they counsel you, don't do this. You don't want to do this, you're going to have tax repercussions. What those advisors many times don't understand is that what you're actually doing when you're choosing to self-direct your IRA is either doing a transfer or a direct rollover of that money out of your IRA, out of your 401k, into a self-directed account. And because this money never touches your hands, it's not a taxable event for you. And when you have your IRA with Advanta make the investment into the private fund, that is your IRA making the investment. So again, it's a non-taxable event. So to move money, even a partial amount of money, you don't have to move your entire account. It's always a non-taxable movement. That's something we do at Advanta when you're setting up your account, making sure those funds are getting moved in the proper way. Now again, when you're in the real estate realm, the types of assets that we see people invest into, single-family homes, whether it's for long or short-term rental, private notes and mortgages, rehabs, mobile home parks, tax liens, REITs, and we're seeing obviously an increasing amount of syndications or private placements where you have individuals finding a piece of commercial property or a multifamily apartment complex. They need millions of dollars in capital in order to make that investment, and your IRA could be a portion of that, and then obviously get filtered back your proportionate share of return. And again, the common thread with all of these assets, obviously they're real estate related, but brokerage firms like Ameritrade and Fidelity and Schwab won't hold these assets. You have to have a company like Advanta willing to hold that asset. Just wanted to show kind of a couple quick case study to show how the process works, to just give you a little bit of an idea before I turn it back over to Neal. We're just going to talk about an individual. John has money in his IRA account, wants to invest in real estate, not really sure yet maybe what he could do or what he's going to do specifically. Could be a rental or rehab property, could be a loan, could be investing in a syndication deal. But he moves over $200,000 from that brokerage account to Advanta so that he has control over the investments and decide ultimately what he wants to do. Now, when he invests through his IRA, all of the income from that investment has to go back into his IRA, and any expense related to that investment gets paid out. And what Advanta does is we will hold his IRA, receive the income into his account, pay any bills at the direction, and then satisfy all the IRS reporting at the end of the year as well. So again, one of the options, he could buy simply a property to rent. It's important that the property, if he's going to purchase a property, it gets made, it gets titled in the name of his IRA account. Ultimately, John is going to be required to find the property, decide what he wants to offer, do his due diligence again on the investment itself. Ultimately, the deal gets funded and closed by Advanta. We will assist that closing process, sign the documents, and ultimately send the money out of his account. Going forward, then all of the rents that come back into his IRA, and again, any bills get paid out of his IRA as well. Again, that could be for a rental, long-term, short-term rentals, or even if you're flipping a property, you can buy just simply that single-family property. And again, we'll walk you through that process. Conversely, John could also invest in a private placement or a syndication where, in this particular case study, there's Randy who has a private offering looking to purchase and remodel an apartment complex. And again, looking for several $1,000,000, John decides, I'm going to put my $150,000 into this deal. So instead of dealing with the tenants and toilets of a single family rental property, I'll put my money with Randy. I'll let him use my cash, use other individuals' cash to buy the project, and I'll sit back and get my return. So again, we're going to work with John and the investment provider to make sure that the investment is titled in the name of his IRA, and also using our tax ID number. And ultimately, we send the funds out for the investment. Those future payments, then the monthly or quarterly dividend checks that come back, will come right back to John's IRA account. And again, we handle all of the reporting from there as well. So why do people use us? I think it's why we're good at what we do. There's no lengthy approval process on paperwork. Especially if you're someone looking to raise capital, we're not going to throw up any roadblocks. We've worked with private placements and individuals for a number of years specifically. And again, we'll put clients with a specific account manager, or if you're referring a number of people to us, put them all with a private account manager. So it makes it a very streamlined and easy process. So that's really all I had to share with everyone today. And Neal, I'll turn it back over to you at this point. I just wanted to give everybody a little bit of taste of what a self-directed IRA is, who's interested. If you have any other questions, please throw them out in the chat box as we go along.
Perfect. Well, thank you, Scott, for warming up that audience for me. We have almost 100 investors that have invested with us through IRAs, but that's not the focus of my presentation today. Today, it's all about real estate trends, and boy, is this a packed presentation. So this is going to go really quick. There's a lot of content to cover. We're going to start off with the 2019 outlook. Keep in mind that the US economy, the jobs, the inflation, the unemployment, the consumer confidence levels all have an enormous impact on real estate prices and on cap rates. So those are going to be discussed first. And then I'm going to go talk about interest rate forecast for 2019 because they have an impact on real estate markets, especially on expensive blue state markets. And then we're going to get into a single family forecast for 2019, followed by a multifamily forecast for 2019. And then I'm going to do something interesting. I've never done this before for trends in my annual presentations. I'm going to tell you the story of apartments in 10 very interesting, very dynamic charts. After that, the most popular part of this presentation is a shootout, the best cities and states in the US for real estate. And I'm going to cover both multifamily and single family. And then I'm going to end the presentation by sticking my neck out and picking one city in the US that I think is the best city to invest in, and one underperforming city that I think should do really well in 2019. So the good news is I don't have to do the disclaimer, the most boring slide of my presentation, because Scott already did that. Thank you, Scott. And I can go straight to the presentation. Yes, you will get a copy of this recording, and you can type in your questions as you want. I'm going to take all the questions at the end. Once again, full deck and full recording will be provided to all of you. So just a little bit about me. I run two companies. MultifamilyU is a mentoring and educational portal. We have about 15,000 people a year that attend webinars and seminars through MultifamilyU. Grocapitus is an investment company. We own about $150 million of real estate, mostly multifamily and student housing, now in 9 states. Now we have over 400 investors that have invested with us. But let's focus on well, actually, there's one more slide. Here's the typical sort of buildings that we purchase. And as you can see, very diverse set, new construction buildings for individual investors. Whoops. Okay, I got to fix something. Give me a second here, guys. This is going to keep flipping by itself unless I fix this tiny little bug. There. Okay, fixed. Let's go back to the page that I was on, portfolio page. So as you can see, most of these are large multifamily projects, but they're all different styles of project. This one here is a glamorous camping or glamping resort. Let me get my laser pointer back, much easier for you guys to see using that. There we go. So this one here is a glamping resort. This one is new construction for a single investor. And this is an ugly building that we've turned into a gorgeous student housing property that now houses about 300, 400 people. So many different kinds of investments. Some of them are new construction. Some of them are much older properties like Windward Forest. So it really depends on what it is that you're looking for and what your beliefs are. You'll get a choice to invest in Class A, Class B, and Class C properties on our projects. But now let's start at the beginning. Any story of real estate trends has to start with the economy and the demographic trends. Without a strong economy supporting real estate, all forecasts would be useless. So before we jump into the nitty-gritty of 2019 real estate, let's spend a few minutes at the 30,000 square foot level. US economic growth, what the bean counters call GDP, is pretty darn strong. Q3 of last year was at 3.5%. Q4 of last year was at 2.9%. This is excellent for a developed economy and is far ahead of what the rest of the developed world is doing. Now, remember, the stock market is not the economy. So even though 2019 growth is projected to be slower than 2018, there's no doubt that we will have the market to support both single family and multifamily growth. Now, consumers buy homes or agree to pay higher rents when they're feeling good about themselves, their jobs, and their economy. And this orange arrow shows that the consumer confidence numbers are extremely high compared to the last 15 years. So the foundation for 2019 is pretty strong, even with the economy slowing and the next recession getting ever closer. But consumer confidence is fickle. It can swing in a matter of months because the biggest factor in how we feel is our jobs. And on that front, the economy has confounded even the most bullish pundits. Since losing nearly 9 million jobs in the 2008 Great Recession, the economy has now created 20 million jobs. And what's really impressive is that we continue to produce 200,000 jobs a month, which is much higher than anyone had predicted. Strong numbers, I have to admit, much stronger than I thought they would be. And those 20 million jobs mean that the gap between the unemployed, that's the orange line, and the job openings, that is the blue line, has been reducing since 2009. And in 2018, we finally ended up in a situation where the job openings are higher than the total number of unemployed people. Whether you believe the government statistics you see here, or you believe the non-official statistics from shadowstats.com, what is very clear is that it is much, much easier to find a job in 2019 than it has been since 2001. Now keep in mind that while the chart above is good news for real estate, it's not all good news. For instance, the real estate construction industry is now facing severe labor shortages, which are affecting both single family and multifamily new construction. So that's great news for those of us sitting on existing rentals, but bad news for the country. Given I'm not in the construction industry, I'm going to personally take that as a positive. And what about those young adults, those millennials? For years, people like me have been moaning and groaning that young people have no jobs and real estate needs these people to buy homes. Well, the good news is that over the last 4 years, young people have been getting jobs. I was really surprised by this graph, but the numbers tend to prove us all wrong very, very often. The orange line and the green lines, well, actually, sorry, this is a different color. So this blue line is the employment rate for all adults, and the orange line is for millennials. As you can see, this huge gap between jobs for younger people and older people that we saw in 2010 is now way narrower here in 2018. In fact, this graph goes back to 1982. And the only time the gap was this narrow was at the height of the dot-com boom right here. Okay, so young people don't have a lot to complain about when it comes to jobs. I have to say, though, that the quality of jobs is another matter. Younger folks are earning less than previous generations, adjusted for inflation, of course. So their ability to buy homes is far lower than the previous 3 generations. Still, they've got jobs. Many of them will buy homes. Others will rent. What's important to us in real estate and what's important to you as investors is household formation. whether it's homeowner households or renter households. We do not want millennials living with their parents. And the good news is that household formation is finally happening. We've had terrific household formations in the last 2 to 3 years from our millennials. So, high consumer confidence, high GDP growth, 20 million new jobs, and low unemployment. Well, all of that sounds like the perfect breeding grounds for the evil hydra that we call inflation. And in the past, all such expansions were snuffed out by this many-headed hydra. Take a look at this particularly ugly graph from Yardi Matrix. In the 80s, 90s, and 2000s, expansions were cut short because labor shortages caused hourly earnings to skyrocket, bringing on the next recession. And what this graph is saying, that we are not near that point yet. Emphasis on yet. These 3 black circles show how spikes in inflation and wage growth caused the 91 recession, the 2001 recession, and then the Great Recession. But now we have inflation moving upwards, but it's moving much slower than the last 3 times. Take a look at the circles and how sharp the lines are, and then take a look at the green box. This means that the inflation hydra is contained, and we could actually have a much longer expansion than most people are thinking about. Bottom line, the US economy is in very good shape for the moment. The trade war could hurt us, and the labor shortages will definitely slow down growth, but the inflation hydra is in jail for now, and consumers are feeling really good. Now let's talk about oil prices for a minute. For decades, no discussion about the US economy was complete without a discussion on oil prices. After all, oil shocks were major contributors to the 70s recession, the 2008 Great Depression. But the US oil shale revolution has changed all that. We are today the largest producer of oil and the largest producer of gas in the world. The shale industry is so nimble that when the price of oil goes up above $65 to $70 a barrel, they open up new wells within weeks, putting a cap on prices. And while higher oil prices hurt at the pump, the profits now flow into our own industry and our own country, resulting in more jobs and money for US shareholders. This now makes it much less likely that we will go into recession because of an oil price shock. So yeah, it looks pretty good for the moment, but there is some bad news coming. I'm just getting started. So interest rate forecast for 2019. If you're reading the news, you know what's getting all the buzz is Trump's very public battle with the governors of the Federal Reserve, which is our central bank. The Fed's been determined to reduce liquidity and raise interest rates. They've now raised interest rates 9 times since 2015, a quarter point each. Until a month ago, they seemed set on 3 more interest rate hikes in 2019. However, they've now publicly softened their stance, including an indication that came in last week. But the Fed does not set mortgage rates. They set an internal rate which influences mortgage rates. But other things also influence mortgage rates, like stock market crashes and money flowing into the US. So to start off, let's look at where the 30-year mortgage rates for home loans are now. So we were at 4.64 in December 2018, the last day of the year. We've now gone all the way down to 4.42. We started 2018 in 4.03. So we're still higher than where we were, right? So we are still about half a point higher, almost half a point higher than where we were at the beginning of 2018. If you look at 2019 estimates, the estimates are all over the place. Aaron from Zillow is saying 5.8%, and I really hope that doesn't happen. We're at 4.4 right now, and we're beginning to see a recovery in the housing market, but that's Zillow's prediction. Luckily, nobody's really agreeing with Zillow. If you look at Realtor.com, they're in at 5.5. Fannie Mae is at 5, and Freddie Mac is at 5.1. So it seems like interest rate predictions for the future are actually moderating, which is good for all of us and good for all of us that are interested in single family and multifamily. The single family forecast for 2019, though, faces some headwinds. There's definitely a growth is slowing, sales are slowing, especially in big metros like the San Francisco Bay Area and New York. So let's quickly take a look at why. Well, clearly the big factor is that this is an extremely mortgage rate sensitive housing market, right? So we're not going downwards. And as you can see, all of last year with interest rates going up, single family prices did go up. But it's not all good, because over here on the right, you notice that as interest rates started going up, single family home sale volume started to decline. And usually when this volume, it's minus 4%, if it goes down to -7 or -8, then you're going to start seeing a plateauing of prices and possibly even a decline in prices. Who would have thought that? So not everything's good. We are hurting because of mortgage rate increases, but the good news is for the moment, the Fed is in a dovish mode and is not likely to raise interest rates much more. Now, how much have we been hurt so far? Well, interest rates went up a few times, but keep in mind, prices also went up. So the total buying power is down a huge number. It's down 10%. Remember, inflation was 2%. So people got basically 2% higher wages, but their buying power was reduced by 10%. And the market response, a slowdown in sales and a significant easing in price momentum all across the US. If you're thinking I'm cherry picking data, here's another data point for you. Keller Williams says that they expect home sale volume, not price, to decline about 2%. So everyone's predicting a significantly slower year in 2019 for single family than they did in multifamily. And really the big reason for that is the millennials. Back in the year 2000, the millennials, 41% of them owned homes. Today, it's 37%. That might not seem like a lot. That's only 4%. But yeah, that's about 2 to 3 million homes. So that's a huge, huge difference. And the fact that home ownership rate for millennials is very anemic is great news for landlords, because that 4% difference is millions of new renter households. Now that they have jobs, now that they're not living with their parents. So bad news for single family often translates into good news for the apartment world. So with sales volume declining, will the prices also decline? Well, the flat answer is no. I'm looking at forecasts from various industry experts, and all of them say that on a national level, single family prices will go up in 2019, but much slower than 2018. For example, Realtor.com is betting on a 2.2% price increase. Zillow is more bullish at 3.8%. Both numbers are much lower than home price increases in 2018. So everyone agrees that the market is slowing rapidly at this point. Bottom line, the 2018 slowdown will extend into 2019. Rates will go up, but much slower. Millennials will keep buying, though at a really anemic level. Home buying power will continue to decrease. There will be more inventory in the market, but we are not predicting it to be a buyer's market in 2019. We're predicting it to be more of a balanced market in 2019. Okay, that's single family. Let's go into multifamily forecast. As you probably know, in the past, this presentation has been more about single family, but I'm focused more on multifamily this year because I have never seen this much of an interest in apartments. It is overwhelming. Every conference that I go to, there used to be the token multifamily speaker, usually me, and now there's 6 of us. There's an incredible amount of interest, so I've expanded the apartment section. But let's start with a look back at 2018. Well, what can I say except 2018 really delivered for apartments? IMG's well-known analyst Carlin even calls it exceptional. I'm not going to go that far, but I have to say it was a pleasing year. But all of that in the past. Let's now look to 2019. Well, the consensus is for more of the same in the apartment market. I put up a comment from one well-known analyst, but most others are feeling bullish, cautiously optimistic. And here's a 1-minute clip from CBRE that does a really great job summing it up.
Richard, we just came out with our 2019 commercial real estate outlook, and notwithstanding the fact that we've been predicting the next recession is 2 years away for the last 5 years, it still seems as though next year is going to be good and maybe going into 2020. What's going on, Richard?
Well, it looks like inflation is under control, and that puts the lid on interest rate rises. We've also got very confident consumers, particularly in America, and we've got a business environment which is very favorable to investment. So all of those things add up to a really good year for growth.
One of the things that makes me particularly optimistic, not just about growth, but about the commercial real estate industry specifically, is capital markets, where while we're not at a record level for international capital flows, we're seeing a ton of it and a diverse amount of it, even though the Chinese capital has fallen off. We've seen our Canadian friends, which have always been our #1 partner, pick it up, but also Singapore capital, which is not only greater in volume, but also the markets that they're looking at. That combined with a deep and diverse debt capital markets, where particularly non-bank financial institutions are providing very inexpensive capital, even when you get to some of the riskier parts of the capital stack, makes me very optimistic for 19.
Well, I would agree with you, Spence. We've got an emerging middle class globally who are saving more for their pensions, and that just gives you a supply of capital that's never ending.
Also, like multifamily in 2019, though I will say we are seeing some cautionary signs in the Class A segment where there's been a little bit of overbuilding. That said, B and C industrial, and in particular workforce housing, looks very attractive, notwithstanding some softness in some of the asset types, particularly A and CBD. We believe that 2019 is going to be a great year.
So that's the analyst forecast, and keep in mind he did have a couple of warnings in there. One is that the Chinese capital is no longer as available, but the Singaporean and Canadian capital has more than been sufficient for the moment to fill that gap. They also mentioned that there is overbuilding in many metros in the Class A or new construction rental market, and we're seeing trends of that. But older Class B and Class C buildings have very, very strong fundamentals for the moment. All right. So now I'm going to show you 5 big numbers, and these support long-term multifamily growth, right? After 7 years of rent increases, this cycle should be petering out. Nothing lasts forever, but there shouldn't be anything that makes the apartment market bulletproof, right? Right? Well, let's take a look. The first big number is 10 million. Imagine a mountain as big as Everest. That's how huge this number is. In the history of this nation, we've never created 10 million new renter households in just 10 years. That is a staggering number, but given the big declines in the homeownership rate, this was inevitable. 500,000 is our second number. So we're going to continue creating 500,000 new renter households through 2025, even though we're struggling to build 300,000 apartments a year. So demand is significantly higher than supply. Our third number is 15 million. And it is a sad commentary on our nation that people are getting married less and are getting divorced more. Singles tend to prefer apartments, so apartments are now becoming part of a lifestyle choice. Our next 2 numbers are about student debt. In a single year, student debt grew by 6% to $1.5 trillion. That number was just 250 billion 15 years ago. That's right. Student loan debt is now 6 times higher than 15 years ago. The average debt, about $40,000. And it's forcing young people to push back their plans to buy homes. In many cases, they may never get there. So now let's expand on this. Let's talk about a story of apartments. The next 10 graphs are going to answer the big question. This is the big question. Why does workforce housing rent growth continue to be so far above the 10-year and 30-year trend lines this late in the cycle? It should not be happening. There's a reason for it. Let's figure out the mystery. The first graph in our story doesn't give you any answers. It actually frames our quandary. Look at the bars from 2011 to 2019. Those bars are showing how many apartment units were delivered after the recession. As you can see, we delivered a lot of units, a heck of a lot of units, especially if you compare it to the 15 years before that. The puzzling thing is that the vacancy rate, which should have shot up, right? As we delivered new units, the vacancy should have gone up. Well, it actually went down as we were delivering that huge number of units. It went down. That's right. We built a 1.5 million units, but somehow magically ended up with higher occupancy rates nationwide, not lower. How did that happen? Well, maybe this graph will explain. This time we're looking at the combined single family and multifamily new construction. Blue bars, single family. Orange bars, multifamily. Now you realize that multifamily supply is really small compared to single family supply. So here's what happened. In 2003, 4, 5, 6, and 7, the total supply, multifamily and single family, was higher than the demand, which contributed to the crash, but wasn't the main reason. In 2008, 9, supply and demand were in balance. 2010, again, we had more supply than demand. Then something weird happened. Both the single family and multifamily developers started building a lot less. And as they delivered less, in 2011, we built only 1/3 of the total supply that we had at peak in 2006. But starting 2011, demand was rising, the gray line, but that demand went up And so a big gap appeared in the market. This is millions and millions of households that just didn't exist. The supply wasn't there, the demand was there. And that gap closed once in 2017, but now with the millennials getting job, there's a lot of single family and renter household formation. It's super strong in 2018 and expected to be very, very strong in 2019. So now we have a new gap developing, and that's what's keeping the rental prices going. Another big factor is the monthly payment. As you can see, except for right here in 2011 and 2012, home payments are consistently higher than rent payments. And that doesn't even count all the costs of maintenance and other things. And that gap has widened in the last 2 years, and it's sustaining apartment demand. But that demand is not across the board. The 3 lines on the graph show you vacancy trends by apartment class. The blue line is vacancy levels for Class A, which is new construction, expensive buildings. As you heard from CBRE, a glut developed in the market starting 2015. And as you can see very clearly, vacancy levels have slowly moved up over the last few years. So only 7% of the incoming inventory was Class B, which is kind of mid-level apartments. And as a result, because only 7% of that new inventory was Class B, slowly their vacancy levels have declined. But the big change was Class C. Since President Clinton ended the HUD development program in '99, we've built almost zero Class C housing. And given the Bs are also in demand, very few of those older Bs were rolling over and becoming Class C. So you can see that Class C vacancy went down from 9% to under 4%. And since no developer in the United States is focused on Class B or C housing, it's likely that Class C will have sustained high rent growth for a while. And speaking of that rent growth, clearly Class C rent growth in red has been strong. The historical average is around 2% down here, and at no point have we been anywhere close to that. Even when the big supply glut hit, and you can see it right here, Class C rent stayed above 3% overall. What that means is it's averaging 3% for the US, so many strong metros, Atlanta, Orlando, Las Vegas, Tucson, are at double those average levels. And you're about to see a list of those in about 10 minutes. Now, syndicators like me, people like me who buy a lot of Class C apartments, were really worried that all this incoming supply would take renters away from our properties. What none of us understood is that only 2% of median income households could afford the rents of these new apartments. That's right, only 2% of tenants can afford the new apartments that are being built today, which is why the existing stock of older apartments, 70s, 60s, 80s apartments, has become such a prize for people like us. And it's not that apartment developers have not tried to compete. They have. As you can see, in the last 10 years, as rents for apartments went up, we also saw new apartments get smaller by over 50 square feet in just a single decade. They were trying to shrink them to make them cheaper. And it wasn't just the apartment guys. Single family properties are also shrinking because of the cost of construction, both labor and materials, rising far, far faster than inflation. And it is this next graph that explains why it is so difficult to fix the problem. Look at the crazy increase in construction costs over the last 26 years. The Chinese are building a New York-sized city every few months. So are the Indians. So the steel and the concrete and the glass and all the other stuff are not cheap anymore. The graph shows that a room that could be built for about $43,000 in 1992 now costs a staggering $110,000 to build. We're not talking 2% inflation here. We're talking 6% or more. And that, ladies and gentlemen, makes it very, very difficult for both single family and multifamily developers to keep building for the common man, for the workforce. And so people like me who took control of those workforce apartments for the common man put themselves in a position to raise rents much faster than inflation. As you can see, historically, rents rise at the same level as the consumer price index, also known as inflation, like clockwork, right? Look at how close it is. But now that connection between rents and the consumer price index is broken because of all the things that we've just talked about. And that leads us to our last graph in our story, which is about apartment prices. We measure these prices in dollars per unit or per door, as the industry calls them. If each door cost $100,000 in 2008, there on the left, it now costs $160,000 on the top right. And this makes it very, very lucrative to buy older 1970s and 80s properties at $60,000 a door down here, spend 10 grand a door on fixing them up, and then renting them out to the common man who is left completely out in the cold because of all these sad trends. And that, I believe, is the biggest, the most powerful, and the most accessible opportunity in real estate over the next 5 to 10 years. Okay, it's time to move on to my grand finale. Let's look at the best cities in the US for real estate in 2019. These top picks are from Forbes and Realtor.com and from Yardi Matrix. I don't agree with all of these picks, but the vast majority makes a lot of sense. But before we do that, let's spend just 2 minutes talking about my company's offerings. So by now you've figured out we're buying Class B and Class C apartment complexes, and we're buying them in metros that have incredibly sharp rent growth. We're buying them in metros where supply and demand are completely out of whack. And then what we're doing is we are reinventing the renovation and leasing process with turbocharged processes that maximize our NOI, net operating income. So much so that we have properties like Equinox. This is a flagship apartment building in Tucson. And we've gone from this is what the property looked like after we fixed it up. Our cash on cash was 0.5% at acquisition, and actual was 27% 20 months later. Our annualized returns that we projected jumped from 19 to 30. Our average rent went up by $257 at the same time when we doubled our occupancy. And we did all of this using our new processes with a renovation budget of just $15,000, though we had budgeted 20. And we're going to do the same thing with a property a mile away. It's called Arbor Villas. This is what it looks like today. This is what it's going to look like. This is the actual unit that Arbor Villas is going to have when we are done. And this is going to be under $10,000 because we're not moving walls. So we're just basically taking our template and refreshing it. For some of you that like new construction, we also have those kinds of projects. This is an excellent 322 unit graduate housing student project. It's in Buffalo, New York, right next to the university, which is over here on the left. And this is what that project will look like when we're done with it. And we're projecting 20+% increases. This, for the purpose of this webinar, I'm not going to go into returns much, but any of you that are interested, please talk with us. I can give you lots of information about it. And that's our sales pitch. Our shameless sales pitch is over. Let's go back to the best cities in the US for real estate in 2019. Let's start with single family. So I'm going to not go through all of these. I'm going to focus on those that I think that you as investors can invest yourself and get cash flow, which is why I'm going to skip Boston. And I'm also going to skip Miami, Florida, because these are markets that are low in cash flow. My first favorite is at number 8, Boise, Idaho. Look at that predicted price growth, 7.9% price growth, and the rent growth is just about that number. So now you can have your cake on the appreciation side and eat it too on the rent growth side. But even better than Boise from this perspective is a market that I invest in, Las Vegas. It didn't build anything at all for 6 years, from 2008 to 14, while Clark County had the fastest growing population in the US, and that's why you see this amazing predicted price growth in Vegas. I'm going to skip Bridgeport, Connecticut, and I'm going to go to Phoenix, which is an astonishingly powerful city. In my mind, Phoenix is one of the most powerful cities for the next 20 years, so you should pay attention to it. But a diamond in the rough is Chattanooga, Tennessee, benefiting from Nashville's growth. I have invested there, and my best performing property is in this metro. And we're projecting 4.3% annualized price growth for 2019. I'm going to skip El Paso. I'm not sure about that one, but I really like Grand Rapids, Michigan. It's seeing white flight from Detroit, white flight from Lansing, and a lot of that money is driving up the price growth, which is at 8.2, a very, very high number. And we're going to go to the next one. I'm very, very happy to see that the corridor of opportunity that I talk about all the time is taking this victory. Lakeland, Florida, halfway between Orlando and Tacoma, and right in the middle of the corridor of opportunity that I've talked about for 2 years, comes in at number 1 with a predicted price growth of 7.4. Now that's Realtor.com's listing. I'm going to give you a second list, and once again, I'm going to skip past most of those. Atlanta at number 9 is a very, very powerful metro that I have 3 properties in and doing really, really well. And then Fort Worth is a terrific place to invest in. And you can look at projected job growth levels are very, very strong for all of these markets. This is Forbes listing, by the way. Indianapolis, a good market to invest in. Charlotte, North Carolina, for those of you that don't mind low cash flow, North Carolina cities are doing incredibly well, and so are Florida cities. Jacksonville is an incredibly powerful market. Used to be mostly military, but now it's across the board. Only 10% of its jobs come from the government and from the military, so very diversified economy now. Another North Carolina city, Raleigh, comes in at number 2, but once again, I'm happy to say that the opportunity the corridor of opportunity wins again with Orlando coming in at number 1. So I'm going to be sending all of you an email about the corridor of opportunity and how to benefit from it. Orlando happens to be at the center of it, and so does Lakeland, Florida. So that's our single family forecast. For those of you that are interested in small multifamily or large multifamily, take a look at this listing and you'll see there's some overlap between the listings. Number 10, Atlanta, very, very strong rental market. Denver is a market to be careful about, so I'm going to skip there because there's a large amount of incoming supply coming in. You see this number? 5% is a dangerous number, so I'm going to skip that one. Raleigh is at 3.6%, a very strong market. Once again, North Carolina showing off its strength. Orange County is doing really well for those of you that are in California, but I'm going to pick a better one up on this list. Minneapolis and St. Paul are 2 good cities to invest in, but better than both of those is Phoenix with its with a rent growth that's projected at 3.9%. Incoming supply is weak. Phoenix is a growing market. It should have higher supply than this. So supply is not going to hurt it, and it's not going to hurt Los Angeles either, because Los Angeles has very low incoming supply at this point in time. Seattle, though, is a market to be very careful about. 4% is a lot of incoming supply, so I'm very hesitant to recommend Seattle. I'm much more bullish on Vegas with only 2% of incoming supply and very, very high job growth. So you see the job growth at this point is at 3.4%. That's a terrific number. So Orlando, though, is even better. Yes, it has quite a bit of supply, not 4, but 3%, but its job growth is astonishing. I have no I feel that you would do really, really well if you bought in Orlando. Dallas is slowing. It's slower than last year, but still a very good market to invest in. But a great market to invest in for all of you that are in California happens to be Inland Empire. This is Riverside, the area east of Los Angeles. Why? No incoming supply. Do you see this green number? There's no supply coming in, so you as a landlord can hike your rents up a lot in Inland Empire, and you can do the same in Sacramento. Sacramento also has very little incoming supply, only 1%, which means as a landlord, you can hike up your rents by 6.5%, even though I would say Sacramento's job growth, not quite where I would want it to be. To me, I think the cities to really look at are very high job growth cities like Vegas, Orlando. Atlanta has a number of long-term trends to look at. So those are great cities to invest in, and so is Phoenix. Look at that amazing job growth. So job growth is what we care about on the multifamily side because that tends to drive the rent growth that we get. And this is for multifamily development. I know very few of you are on here. I just wanted to point out 2 cities that you should consider investing in. Jacksonville, Florida is a great city to invest in for new construction, and so is Salt Lake City, Utah, where I've built and have benefited greatly. And we're going to finish off this presentation with me sticking my neck out. I'm going to pick an underperforming market and my best market for 2019. So let's end the presentation with our 2 markets. I believe that the most underperforming market in 2019 that has great opportunity is Kansas City, not Kansas City, Kansas, but Kansas City, Missouri. And I can also, you know, my own personal analysis has been confirmed with the fact that the new construction guys who have the best analytics are coming in 52% year-over growth in new development spend. Those guys are institutional. They do not come in until they're really, really sure. That's Kansas City, but I don't think it's the top market for 2019. My last slide is about the top market in 2019, and that happens to be a city that's filled with potatoes. For the 2nd year running, my pick for best market is Boise, Idaho. And I picked this amazing city because of terrific inward net migration. It's stealing people from every state. It has a very, very high livability ranking, great job growth. Look at that unemployment rate, 2%. Low crime. It is the 8th safest city in the world, not in the US, in the world. It is projected to be the #1 price growth in the US by Ingo Windsor, a friend of mine who's very, very smart. He does predictive analytics for real estate. Very highly regarded schools, beautiful, beautiful outdoors, and very low property taxes. All of those lead to me picking Boise once again as my top market in 2019. So check out Boise, Idaho, and also check out the Real Estate Trends Toolkit. Thank you so much for joining me. I know this was a fire hose presentation, but hey, we did get finished in time. Awesome. Scott, comments? Did I put you to sleep?
No, it's great information. I think that's always, especially again, the people that we know and work with, they're always looking for what the new market and kind of what the trends are. And it's good to hear about other markets sometimes other than where they live and that's all they know. Obviously, there's a lot more opportunity out there than just your backyard.
Yeah, absolutely. I mean, one of the key things is that markets change over time. 3 years ago, people were complaining about me when I invested $7 million of my investor money in Vegas. And today, as you can see, it is one of the highest performing markets in the US. It's all about supply and demand, and most people don't understand that. Orlando also crashed hard. Phoenix crashed hard. So did Vegas. When cities crashed hard, they didn't build anything for 6 or 7 years. But because those cities were cheaper to live in, people fleeing from high tax blue states were going there. So their population was going insane at the same time when they weren't building anything. Well, all of those lead to massive home price growth and eventually to massive rent growth. So these kinds of events, we teach them on our website. They're in front of you. We teach about 50 of them. We just taught this one last night. So this one, John Brixton's event was last night, and we have this event coming up tomorrow. So we're constantly teaching about these secrets. Like opportunity zones is an enormous $500 billion opportunity that you should take this particular event. It's absolutely mind-boggling what the tax benefits of opportunity zones are. And so take a look at those. And there's so many other presentations on our website. So let me take questions. Here's the question. Why is the negative rent growth so high for Vegas? It's not negative rent growth. It is decline in growth. That's not the same thing. Last year, Vegas had a very, very high rent growth, 8 or 9%. But 8 or 9% is absolute insanity. We don't get that kind of rent growth anywhere in the US. So now it's down. It's down to 5 or 6%. But that's still at the very top of the market. So it's just simply saying that it's not, Vegas is not going to grow as fast in terms of rent growth as last year, but that still puts it in the top 5 markets in the country. So nothing wrong there, Richard. Any other questions? All right, I see a couple more. So for those of you, for those of you that are interested in investing with us, please send an email. You've got my email address right here, Neal@Grocapitus. And also, I will be sending this presentation, this deck, and this webinar out to all of you that attended this event. So you'll have an email from me that will come in the next day or two. Just click the reply button, and we'll tell you more about our projects. As I mentioned, we definitely work with IRA providers. Advanta is one of the top IRA providers that we work with, and so we can certainly leverage your retirement funds. Okay, all right. I think we're done 3 minutes early. Yay!
All right.
Already. Thank you so much. There is a question actually for Advanta from Karen. What is the administrative fee to maintain an IRA account at Advanta?
Our annual fee is a flat $295 a year. It doesn't matter the value of the asset that we're maintaining, whether it's a single family home, whether it's an investment into a syndication. It's a flat $295 a year is our annual fee.
Got it. Okay, so I have now more questions. What do you feel about Austin, Texas? In my mind, not a great rent growth opportunity, but it is one of the greatest 10-year and 20-year markets in the United States. So multiple people ask it. So I think Austin's great if you can be patient. There are very few markets that strong. Tampa, St. Petersburg, Multifamily, incredible. Tampa is part of the opportunity corridor that I will be sending an email to you about. It's actually more or less in the middle of it, maybe 2/3 of the way through the corridor. The corridor runs from Deltona to Cape Coral's Fort Myers, and everything in that area is booming, and you'll do really, really well there. Multiple questions from Andrew and others about Reno. I think Reno is a terrific market, but it's also a little bit bubbly. So be a little bit careful. You might, Sparks or Carson City might be a little better than Reno because the cap rates in Reno are really, really low. So you'll have trouble finding anything that cash flows in Reno. But I think that the city is set for growth because it is a city with all the benefits of Las Vegas that is so close to California. I think it will do terrific. And then I have another question here. This is for Scott. Does Advanta handle UBIT filings for SDIRA?
We don't do the filings themselves, but we certainly can refer you to CPAs and other people who can help you with doing that. So yeah, whether or not UBIT's going to apply, or obviously what your tax liability is, we would refer that out. That's just not something we currently do in-house, although we've talked about doing it.
Perfect. Okay. Well, that was the last question. Thank you all for attending. Keep coming to multifamilyu.com for more webinars. We do over 50 of them a year, and we hope to work with you soon. Thank you all for your time, and thank you, Scott, for setting this up.
All right. Thank you, Neal.
Alrighty. Bye-bye.
Bye.